Hey class, welcome to Module 7, Week 7. This week we're in Chapter 14, and we'll be talking about the market approach and discounts and premiums. Okay, so within the market approach, you'll either be looking at public companies for comparison, or you'll be looking at past transactions of private companies or public companies, but mostly private companies. So for a public company, you're going to be looking for a company that's within the same industry, same amount of total assets, similar revenue range, and you'll be applying metrics of that company to your own to come up with the value. So what you would most likely do is look at the public company's MVIC, which is market value of invested capital, which is the fair market value of equity plus the fair market value of interest-bearing debt. And that's essentially just the equity holder and the debt holder's investment in the company. And so once you have that, you compare it to sales or EBIT or EBITDA, and you would take that multiple and apply it to your own company to calculate the value. Now for transactions, instead of looking at the MVIC, you're looking at the transaction purchase price for that similar company. And again, you're looking for companies that are in the same industry, companies that have the same or similar amount of assets, similar revenue range, and then you're taking that price to sales or price to EBIT or EBITDA multiple and then compare it to your own to calculate a value. All right, so that's the market approach in brief. Now discounts and premiums. There are many different reasons why you would want to apply a discount to a company or at a premium, but the two most common ones are DLOCs and DLOMs. The DLOC is a discount for lack of control, and you're going to be applying this whenever you're valuing a minority interest or an interest that is majority, but for some reason it lacks control. So you're going to be applying that, and you always apply the DLOC first. Then you have the DLOM, which is a discount for lack of marketability. So this is a discount you're going to be applying if an interest you're valuing is just not marketable because it's either illiquid or there are restrictions on the resale or transferability of the particular interest that you're valuing. And then there are premiums. One example of a premium is we got it listed here below, is the S-Corp premium. So, there are different entity structures for companies. You can be an S Corp, a C Corp, a partnership and limited partnership, a limited liability partnership, LLC, and so on. And there are different tax implications for these different entities, right? So there has been research that suggests that an S corporation, for example, which is a flow-through entity, meaning that the entity itself is not taxed, but rather the income passes through to the shareholders and they're taxed at their individual level, which holds that holds a benefit because in many cases the corporate tax rate would be higher than the individual tax rate. So you get sort of a savings there, and valuation analysts argue that there is value in that particular entity structure because you're getting a savings, and so therefore they place a premium on the company. So there's a lot of debate about that. But that's it, guys. Those are the only two major things I wanted to cover this week. So remember, you got to turn in your final valuation report. And if you have questions or problems or anything, just let me know. Have a good week.